right now we are going to study the difference between cash and accrual accounting. Under cash accounting, revenues are recognized when the cash is received, and expenses are recognized when they're paid. Accrual accounting, though, under accounting is the correct way to record transactions. Accrual accounting is the only acceptable method under GAAP, generally accepted accounting principles, and accrual accounting is the method that we are studying this semester. Under accrual accounting, revenues are recognized in the period of time in which they're earned. So revenues are recognized to the period earned. And to earn a revenue means that you have already performed a service or already given up possession of goods. In accounting, we never book things that are going to happen. We only book things that have already happened. Expenses are recognized in the period of time in which they're incurred, so expenses are matched to the period of time in which they're incurred. To incur an expense means to use up the underlying resource. So, you incur salary expense when workers do work for you, not when you pay them, but once they've done the work for you, salary expense is incurred, and you incur rent expense when you occupy premises. Not when you pay your landlord, but when you occupy premises. So let's take a quick look at the difference between cash and accrual-based accounting. Now we're going to take a look at this right in this section over here. So let us say, for example, that you pay your December rent late. Let's say your rent is due on the last day of every month, but you pay your December rent late. So you pay your December rent on January 5th, and your landlord says that you have to pay your January rent on time, so you pay that on January 31st. So you actually have two cash payments of $1,000 for rent during the month of January. So under cash accounting, on January 5th you would show a rent expense, and on January 31st you would show a rent expense. Therefore, you would have zero rent expense in December because none was paid, and your rent expense for January would be $2,000. You can see here that under accrual accounting, as of December 31st, we would recognize that we occupied premises for 1 month and hadn't paid it yet. So therefore, we owe that $1,000 of rent. So this is the adjusting entry that we would do at the end of December. Then, on January 5th, instead of having a new rent expense, we'd be basically paying the landlord the money that we owe for the month of December. Then, on January 31st, paying the rent on time, we would show another $1,000 of rent. So, under accrual accounting, we would have a $1,000 rent expense in December and a $1,000 rent expense in January, even though both were paid during the month of January. Okay, I hope you understand accrual-based accounting a little bit. Now let's talk about unearned revenues and prepaid expenses. So first let's talk about unearned revenues. Excuse me. Okay, under accrual accounting, if you receive money before you earn it, it is not a revenue, it is a liability called unearned revenue. Liabilities do not have to be debts of money. They can also be debts of property or even debts of service. In this case, our unearned revenue is a debt of service, but it is considered a regular liability account. It has a dollar balance and it shows up in the liability section of our balance sheet. So let's give a quick example. Suppose I'm Rihanna and I have signed a contract and I've received $9 million in advance. For the $9 million, I have agreed to I've agreed to deliver 3 albums in 3 years. So what I would do when I receive the money is to debit cash and credit unearned revenue. I couldn't show any music revenue at all from the $9 million that I received because I hadn't done anything to earn it. If I don't give the 3 albums back, if I don't deliver the 3 albums, I would have to give the $9 million back. And yes, once I receive the $9 million, I owe the record company something. not money, but services. So let's say then I deliver the first album. Then I've performed 1/3 of the services under the contract, so I would consider 1/3 of the revenue is now earned. So I would debit the unearned revenue, so the unearned revenue would now stand at $6 million because I have a $9 million increase and a $3 million decrease, which means that I still owe 2 albums, and I would show that I've earned 1/3 of that amount because I delivered one of the albums. Okay, hopefully that helps with your unearned revenue. Now, let's talk about prepaid expenses. So, excuse me. Under accrual accounting, if you pay money in advance of incurring it, it is not an expense, it is considered an asset. So, insurance paid in advance would be called prepaid insurance, and rent paid in advance would be called prepaid rent. So let's give an example of this. Suppose at the beginning of January you pay rent for the next 4 months $8,000. So if you're charged $8,000 for 4 months, basically your rent is $2,000 per month. As of January 1st though, no rent expense exists yet because you have not yet occupied premises. But what you do have is an asset that entitles you to occupy premises for 4 months. So, when you pay the money, you would debit prepaid rent, which would be considered an asset, and you would credit the cash. Now, when we fast forward to January 31st, we do no longer have 4 months in the bank. One of those months have expired, we've occupied premises for a month, and we have to match the cost of that to the period of time. So 1/4 of the amount is now incurred. So what we do is we debit rent expense to show the rent expense, and we'd credit the prepaid rent for the same amount. Adjusting entries have to balance, all of our journal entries balance, and increasing prepaid rent by $8,000 and then decreasing it by $2,000 would show that there is a $6,000 balance, which would be the 3 months remaining, and the rent expense shows the 1 month expired. Okay, hopefully that explains the difference between cash and accrual-based accounting. After you've gotten this, I want you to listen to the next recording that explains adjusting entries.